If you recently bought your first home or are getting close to closing, you've probably heard the word escrow thrown around a lot. Maybe your lender mentioned it when explaining your monthly payment. Maybe you saw it in your closing disclosure and were not totally sure what it meant. Today, we're going to clear all that up. My name is Robert Porto and I'm a home loan advisor. My team and I have helped hundreds of families across the nation navigate the home buying process while making it stress-free. In this video, we're going to cover exactly what an escrow account is, how it works, what goes in and out of it every month, and this is the part most homeowners don't find out until it's too late. What happens when escrow account has a shortage or an overage? By the end of this video, you're going to understand your mortgage payment in a way that most homeowners never do. All right, let's get into it. What is an escrow account? Let's start with the definition. An escrow account is a separate account held by your mortgage servicer. This is the company you send your monthly payments to that is used to collect and pay certain expenses on your behalf. Specifically, it collects money for your property taxes and your homeowner's insurance, and in some cases, your HOA dues or other assessments. Now, here's why it exists. Your lender has a significant financial interest in your home. They loan you hundreds of thousands of dollars secured by the property. If your property taxes go unpaid, the government can place a lien on your home that takes priority over your mortgage payment. If your homeowner's insurance lapses, your lender's collaterals is also unprotected. The escrow account exists to make sure that the bills always get paid on time, every time, regardless of whether the homeowner remembers to pay it. From your perspective as a homeowner, it's actually a pretty convenient system. Instead of receiving a large property tax bill twice a year and scrambling to come up with several thousands of dollars on short notice, you're setting a little aside every single month. So when the bill comes due, the money is already there. How does an escrow account work month to month? Here's how it works in practice. Every month when you make your mortgage payment, that payment is split into multiple parts. Now, you've probably heard of the term PITI, principal, interest, taxes, and insurance. The principal and interest portions go towards paying down your loan. The taxes and insurance portions go directly into your escrow account and sit there until the bill comes due. Let's walk you through an example. Say your annual property tax is $6,000 and your annual homeowner's insurance premium is $1,800 per year. Together, that's $7,800 per year in escrow expenses. Now, divide that by 12 and you get $650 per month going into escrow on top of your principal and interest payment. When your property tax bill comes due, typically twice a year in most states, your mortgage servicer will pay that money out of your escrow account. And you never have to write those checks yourself. The servicer handles it all. Now, your only job is to make your monthly mortgage payment on time. Here's something a lot of first-time homebuyers do not realize. Your escrow account isn't just designed to have enough money to cover the bills. Your lender is allowed to require what's called an escrow cushion. The escrow cushion is an additional reserve balance that your lender keeps in your account as a buffer. Federal law, specifically the Real Estate Settlement Procedures Act, or RESPA, limits the cushion to no more than 2 months worth of escrow payments. So in our example, where you're paying $650 per month into escrow, your lender could require you to keep up to $1,300 in the account at all times as a cushion on top of what's needed to pay your upcoming bills. At closing, you'll typically be required to fund this initial cushion upfront as part of your prepaid costs. That's one of the reasons closing costs can feel surprisingly high, because you're essentially pre-funding your escrow account for the first few months. What's an escrow analysis? Once a year, your mortgage servicer is required by law to review your escrow account. This review is called an escrow analysis, and this is the part that catches most homeowners off guard. Here's what the escrow analysis does. Your servicer looks back at what actually came out of your escrow account over the past year, what your property taxes and insurance actually cost, and then projects forward to estimate what those expenses will be in the coming year. If those numbers have changed, your monthly escrow payment gets adjusted accordingly. Why would they change? Well, a few reasons. Property taxes go up. In most areas, property taxes assessments are adjusted periodically, and they tend to increase over time as home values rise. If your home value was reassessed at a higher value, your property tax bill likely went up, and your escrow payment will need to keep pace. Homeowners insurance premiums can also increase. Insurance costs have been rising significantly in recent years across much of the country. If your insurance company raised your annual premium at renewal, that increase flows directly through your escrow payment. When you receive your annual escrow analysis statement in the mail, don't set it aside. Read it carefully. It's going to tell you exactly what changed and what your new monthly payment will be going forward. Quick pause. If you've ever opened a letter from your mortgage servicer and you had no idea what it was telling you, this channel is for you. We post new videos every week breaking down homeownership topics in plain English. So hit that subscribe button so you don't miss a thing. All right, let's keep going. Now pay attention because we get to the part that surprises and sometimes stresses out a lot of homeowners, the escrow shortage. An escrow shortage happens when your escrow account doesn't have enough money to cover your upcoming tax and insurance bills, plus maintain the required cushion. This typically happens when your property taxes or insurance premiums went up during the year and your monthly escrow contributions weren't enough to keep pace. Here's a real example. Let's say your property taxes increased by $600 this year, $300 per installment. Your escrow account collected what was supposed to be based on last year's estimate, but it came up $600 short of what was actually needed. That $600 is your escrow shortage. Now, when your servicer identifies a shortage during your annual analysis, they have two options for how to handle it. The first option, and by far the most common, is to spread the shortage repayment over the next 12 months. They add the shortage amount divided by 12 to your new monthly payment. In our example, that's an extra $50 per month on top of whatever adjustments you already made for the higher tax bill going forward. This is why your mortgage payment can creep up even when your interest rate hasn't changed. The second option is to pay the shortage in a lump sum. If you have the cash available, this can be a smart move because it keeps your monthly payment lower. When you receive your escrow analysis statement, it will typically give you the option and a deadline, usually 30 days, to pay the shortage in full before the spread out repayment kicks in automatically. What is an escrow overage? An escrow overage is the opposite situation, and it's a good kind of surprise. An overage happens when your escrow account has more money than it is required. This can happen if your property taxes came in lower than estimated, or if you switch maybe to a less expensive insurance policy, or if your servicer over-collected slightly during the year. Federal law requires your servicer to refund any overage above $50 directly to you. If your escrow account has an overage of $200, for example, you'll receive a check or a direct deposit for that amount after your annual analysis is complete. Some homeowners are tempted to treat this as a windfall, but it's worth remembering that it's your own money coming back to you. It simply means your servicer collected slightly more than what was needed. Going forward, your monthly payment will be adjusted downward to reflect the lower projected expenses. If you receive an overage refund, a smart move is to set it aside in a savings account as part of your home maintenance fund, rather than spending it immediately, because the next escrow analysis might bring a shortage. Why did my mortgage payment change? This is one of the most common questions homeowners have, especially in years 1 through 3 of owning a home. And the answer almost always comes back to escrow. Your principal and interest payment never changes on a fixed rate mortgage. That number is locked in for the life of the loan. What changes is the escrow portion of your payment, driven by increases in your property taxes or homeowners insurance premiums. In recent years, homeowners across the country have seen their mortgage payments climb despite having fixed rate loans, purely because of rising insurance costs and property tax reassessments. This is normal and expected, but it can feel jarring if you don't understand why it's happening. The best thing you can do as a homeowner is to read every escrow analysis statement you receive. Understand what drove any changes and budget for the possibility that your payment will increase slightly from year to year. If you're currently in the process of buying a home, ask your lender to estimate not just current taxes and insurance costs, but also how those might be trending over the first few years. Recap and next steps. Let's bring it all together. An escrow account is held by your mortgage servicer and used to collect and pay your property taxes and homeowners insurance on your behalf. Here's what to remember. 1, your monthly mortgage payment includes a portion that goes into your escrow account every single month. 2, your servicer pays your property taxes and insurance bills directly from your escrow account when they're coming due. 3, your lender is allowed to require an escrow cushion of up to 2 months worth of payments as a reserve buffer. 4, once a year, your servicer performs an escrow analysis to compare what was collected to what was actually spent and project the coming year expenses. 5. An escrow shortage means the account actually came up short and you'll either have to repay it or spread over 12 months or in a lump sum. 6. An escrow overage means the account had more than needed. An overage above $50 gets refunded back to you. 7. If your mortgage payment goes up on a fixed rate loan, the escrow portion is almost always the reason why. Understanding your escrow account puts you in control of one of the most misunderstood parts of homeownership. Now, when that annual statement shows up in the mail, you know exactly what it's telling you and exactly what to do about it. Drop a comment below. Have you ever received an escrow analysis that caught you off guard? I read every comment and I'm happy to explain to you what you're seeing. And if you haven't subscribed yet, we post videos every week to help first-time buyers and new homeowners navigate the process with confidence. See you on the next one.